Hi everyone. Everyone thinks the choke point of AI boom is in GPU. It is not. The real bottleneck now is having enough megawatts to keep these AI factories running. The gap between AI demand and the actual electricity supply is quietly turning into one of the biggest investment themes of the decade. This is part one of the three-part series on AI versus the power system. First, power gap. Not enough clean energy generation for all the AI demand. Second, transmission gap. Not enough grid for power to be transmitted to where it is needed. Third, equipment gap. Critical equipment like transformers, switchgear that simply do not show up in time. In this episode, we will tackle the first point, size the power gap, look at what kind of generation AI really needed, and walk through the companies that are actually solving their problem. If you care about AI and also curious where the investment opportunity could be, stick around. Hey, this is Business Decode with Karen. I spent over 10 years in strategy consulting, and on this channel, I break down business model and trends like AI into clear investment idea with structural analysis. If that's your thing, hit subscribe and stick around for the video. How big is the AI-driven power demand? First, we need to size the demand. This isn't a small bump in the electricity use. It is a rewrite of the power system. Total hyperscaler data center capacity is expected to grow by almost 3.5 times by 2030, driven by both more sites and much larger average size. More data centers, denser rack means a complete change in power lead. If you add up the announced AI and data center project, US data center alone could account for roughly 12% of the national electricity use by 2030. According to City Research, global data center IT power demand is projected to reach around 100 gigawatts by 2030, with AI workload growing at roughly a 43% CAGR from 2033 to 2030. AI shares goes from almost nothing in 2022 to close to half of the total data center IT load by 2030, overtaking core, cloud, and other workloads combined as the main driver. So AI isn't just a software story anymore. It's all about power. Okay, so power demand is exploding. What else? AI isn't just about storing more data. It is consistently rereading and recomputing it. Training large models and then serving billions of inferences turns data center into a 24/7 industrial scale loads. There are two broad types of AI workload that matters for power: training and inferences. They behave very differently from an energy and infrastructure point of view. Training is essentially one-off computational event with a fixed energy budget that you amortize it over the model's time frame. Training means more power dense, spiky workload with a very high peak draw. When compared against inferences, training GPT-3, for example, consumed about 1,200 megawatt of electricity, roughly equal to the annual usage of around 130 US households. Estimates suggest that AI training demand would grow to around 200 terawatt by 2030, but its shares of total AI electricity falls from about 70% to 2025 to well under 40% of 2023 as inferences scales. So how does inferences power demand look like? Inferences already account for around 30% of the AI electricity in 2025. It is expected to overtake training around 2028, and by 2030, roughly two-thirds of all AI electricity is likely to be spent on inferences as model gets more embedded into search, productivities, and enterprise apps. There's one vivid example that you may remember as well. So when OpenAI rolled out the ChatGPT 4.0's new image generator function, millions of people started cranking out Studio Ghibli-style selfie. Each image only runs the model for a few seconds, but at 10 or thousands of millions of generation per day, the GPU cluster hit its thermal and power limits so hard that the Sam Altman publicly said, "Our GPU are melting," and OpenAI limited the features to around 3 images per day for the free tier. That's inferences in a nutshell. No single request is huge, but multiplied by hundreds and millions of user actions, you very quickly get utility-scale electricity demand. On top of needing more energy, AI is changing how data centers consume power. Traditional cloud traffic was relatively predictable. With AI, the profile is much more volatile. AI-heavy data center can ramp power consumptions extremely quickly. One analysis notes that a training cluster with 25,000 H100 GPU can increase demand by 50 megawatt within minutes, suddenly connecting tens of thousands of homes onto the grid at once. Cooling has to follow these compute swings. When GPU utilization spikes, liquid cooling and chillers ramp hard to more volatility on top of the electrical load. As AI shifts from training-dominated to inference-dominated consumption, the system has to support both massive peak capacity for training and sustained baseload power for inferences, which tends to favor nuclear and natural gas over purely intermittent renewables for the critical part of the stack. Data center operators are therefore increasingly targeting the 5 nines availability, 99.999% uptime, or above just 5 minutes downtime per year. Put simply, the existing data center power infrastructure was never built for this combination of density, volatility, and reliability. Linking it back to the investment opportunity. Now let's talk about who might actually benefit from this power gap, which companies actually solving the problems, aka our investment opportunities. The first stock that I want to cover is CEG. So CEG is essentially the nuclear energy generator of the AI trade. It runs the largest US nuclear flights, plus some gas, hydro, wind, and solar. But nuclear is definitely the profit engine and the strategic focus. Revenue comes from selling power and capacity into wholesale market and form long-term PPA with big customers like utilities, corporates, and of course now hyperscalers. Its 24 to 26 CapEx is around $6.5 billion and is heavily skewed towards data center. The strategy is to turn individual nuclear plants into dedicated power hubs for hyperscalers. One example is Microsoft 20 years PPA tied to restarting the 835 megawatt 3 Miles Island unit and mattress deal for Clinton energy bills. So the next stock I want to talk about is NEE. NEE is the largest US renewables and storage developers, and they're already working with big techs on renewables plus storage and dedicated power deals. Hyperscalers are increasingly shifting to bring your own generation models. They invest in dedicated new generation, often gas plus renewables and storage, while developers like NEE sites, permits, builds, and operates the plant. The generation can be physically tied to the campus, but also interconnected to the wider grid. One example is the restart of the Dwayne Arnold Energy Center in Iowa as a dedicated power source for Google data center under a 25-year deal, with Google financing the refurbishment and NEE operating the plant. Then the third stock that I want to introduce is Bloom Energy. Bloom Energy is positioning itself as the on-site power plant for AI data center. The company sells the Bloom Energy server solid oxide fuel cell modules, plus installation and long-term service contract, with revenue split between products and system are modular and sited at the customer facility, running on natural gas or hydrogen to deliver continuous power. The pitch is simply to become the standard for bring your own power in the power-hungry AI infrastructure industry. In 2025, Bloom reported about $2 billion of revenue, up around 37% year-on-year, with 30% gross margin and a total backlog of about $20 billion. It has deployed around 1.5 gigawatts across roughly 1,200 sites globally. Zooming out from the hype, the first phase of AI trade was all about chips and GPUs. But none of that scales without something much more basic, enough reliable energy to keep this AI factory running 24/7. If the AI data center load really grows the way that the market is predicting, the asymmetric upside may not be in the front-end AI names everyone talks about, but in the power side